Hello, this is Steve Torrey and Andy Melnick from First Capital Investment Partners. Thank you for joining us today. Jim, Jeff, Andy, and I, and the entire First Capital team have been closely monitoring the events of coronavirus as well as the oil discord and their impact on the economy as well as different markets and asset classes, and many of which are part of your portfolios. So today we'd like to start off with discussing a brief overview of the coronavirus and oil. Many people have asked about how is this similar or not similar to 2008, and then we'll briefly talk about different monetary and fiscal policy measures that can be taken to help mitigate the negative impact this could have on the economy and the markets. Andy.
Thank you, Steve. It's great to be with you all. I wanted to comment on the two issues that have really moved the market. One is the coronavirus epidemic, and the other is the oil price war. In the case of the coronavirus epidemic, the most important thing is to think about the probability of how long it may last, particularly in the United States. And looking at the experience of both China and South Korea, based on those two countries, it's probably reasonable to expect that from the start to the peak to the finish lasts about 35-40 days, which suggests that sometime at the end of April, early May, we should be beyond the worst of our experiences, and hopefully people will become more comfortable in that environment. The second issue that occurred was the oil price war between Russia and Saudi Arabia, the kingdom. The reason this occurred was that over the past few years, both Saudi Arabia and Russia have agreed to keep the production down in order to keep prices up. In their weekend meeting, the last weekend, Russia decided that keeping the prices up was a mistake. The reason it was a mistake is that it would help the fracking production in the United States continue to pump out oil, which kept the prices under wraps. So the decision by Russia was to say, the devil with it, we're going to let our production go. The Saudis said, if you do that, we're going to increase our production. So we saw a decline in the prices from the mid-40s to the low 30s and even lower. Our expectation is that because commodities typically in a low price environment create the environment ultimately for the price to go up, we will see oil production decline as the frackers have to pull back production. It's not profitable, and others with high cost production will also pull back. So from your perspective, we think we'll start seeing higher oil prices as we move towards the end of this year and into next year. Steve?
Sure, and that also has an impact on many energy companies, and those many of those companies are some of the more highly levered businesses out there. They've raised lots of money through debt, and there will be significant, we think, impact, particularly in the high yield market on in general, but more specifically focused on those energy companies. As you might be aware, First Capital has moved out primarily of any high yield exposure last year, and are clearly avoiding those energy companies and their debt at this time until the dust settles and see how this can be worked out. Additionally, we've heard from people about, is this another 2008? And we want to make it clear that this is a very different environment. And this chart shows, we're looking at a car crash on the left, and that really represents the great financial crisis, as it was called, in 2008, where that crash froze the financial system, the global really financial system, and many banks were either insolvent or close to being insolvent, and there was no lifeblood or lifeline feeding the markets, and all asset classes sold off or were impacted, and it took a long time to rebuild that car to get back on the road to be running effectively. Today, with coronavirus as well as the oil discord, we could view it much more like a disruption, as if you were driving in a terrible rainstorm and had to make a decision to pull over to the side. And that's what's happening with businesses, cutting back on production, the quarantining of people, therefore they can't go to work. This is a disruption that will last until the virus subsides and testing is more widely distributed throughout. If you look at the US, one of the things impacting us was that there was no testing available. That should change in the near future. People should have greater insights on who does actually have the coronavirus, and hopefully we cut off the peak of the rise of that infection and its impact on the economy, as well as the markets. And after the rain stops and that storm slows down, you can get back on the road. And now that's where the government, with fiscal policy and possibly a little monetary policy, but primarily targeted, focused fiscal policy, is very important to make sure that those bridges that you need to cross are not washed out, or if they are washed out, that they're rebuilt very quickly. So the economy, which was in very good shape coming into this period, can get back on the road again and running. In the last call we had, we discussed how important it is to remain invested through periods like this, and how Jim and Jeff and the First Capital team focused most of their time on making sure the allocations you have are best for you to meet your long-term objectives. And therefore that upfront work that they do is critical in the long-term success in achieving your objectives. And what this chart shows here is that how important it is to remain invested, not try to time the markets, because that's a very difficult thing to do, and most people fail at that. And on the bar on the left, you can see that's through the period of 1999 through 2018. If people remained invested, investors stayed in through the ups and downs of the market, their returns were over 2.5 times greater than if they missed the 10 best periods days during that period. And you can see here that on the upper right, 6 of those best 10 days occurred within 2 weeks of the 10 worst days. So we're going to see more of that, as we saw recently, the market's going down a lot and up a lot on back-to-back days. And really, we're focusing closely on finding opportunities, and this is creating opportunities that we are taking advantage of that can provide better risk-reward opportunities for the First Capital team and clients going forward. So thank you for being with us today. Jim, Jeff, Andy, and I appreciate your confidence and look forward to speaking with you in the near future and answer any other questions you might have. Thank you.